the biggest 500 names. And we can see, of course, that once again, we are seeing the AI and semiconductor thematic is continuing to produce some of the most profound and biggest returns. Of course, we all know names like NVIDIA and Super Microcomputer. They're up in the order of, as we can see at the top, 125, 145%. But again, we want to think about long-term thematics. Sure, they're in a pullback, which we'll get to in a sec, but this continuation of this long-term trend of their shares hitting higher highs over the longer term is expected to continue for the most part. That doesn't mean that we're not going to experience pullbacks. We're experiencing that right now. On the right-hand side of the screen, we've got the ASX 200. And we know the leaders of the ASX 200 this year, we've got Zip and Life 360. And in the instance of Zip, that's a beneficiary of the rate cuts that are probably going to be coming down the barrel. Fed rate cuts, the first one expected from September. And we can see that down the bottom I've just highlighted. This is the Fed Fund futures, and the market is now fully pricing in the first rate cut of this cycle in September. Potentially another cut is expected before we close off 2024. And there's about a 90% chance, let's call it that, of a Fed rate cut in December. And then, sure, there's a higher probability of another cut in January. But all in all, we do know when, to answer one of your questions, someone said, what does Fed rate cuts mean for the equity market? And of course, we know, as we've been saying for some time in all of our commentary and the media that I do here, that rate cuts are supportive of equity valuations. And particularly that's why we've seen the small caps in the US and also here in Australia start to really outperform big tech names. And that's because they're benefiting from the expectation that they will have greater profits when the Fed cuts interest rates. The other big thematic that we can see in terms of what stocks are generating the most hot sauce or upside are uranium. And so if we have a look, number 8 on the left, the best performer, the 8th best performer is Constellation Energy. We'll be covering why that is. And also you've got other uranium names in the US, such as NRG and Vistra as well. These are fossil fuel companies, but they're increasingly producing and selling uranium as a clean energy source. And we know companies like Amazon and Alphabet are directly getting their clean energy source straight from these companies. So this is something that we want to continue to watch. The other theme that's dominating the leaderboard is, of course, commodities. And so we saw commodities. We all know the copper price hit record all-time highs a couple of months ago. It's pulled back. Aluminium also records, it's pulled back. But there's one commodity that's kind of continuing to stay around record high vicinity neighborhood, and that's the silver price as well as the gold price. And we know that gold companies are likely to be supported higher with the pullback of the US dollar. Remembering gold and the US dollar have got that inverse relationship. And so we can see that gold producers are in the mix and are some of the best performers in the ASX so far this year, including West African Resources. It's up 50%. Overwhelmingly, the biggest thematic and the biggest mega trend of our generation, indeed of my career in financial services, which is spanning 17 years now, embarrassingly, the biggest thematic is AI and chips. And that's the mega trend that is going to be hit with a freight train, a $1.3 trillion freight train of spending right through to 2032. So make no mistake, this is going to really set up a lot of companies for earnings upgrades. So we've started to see that with NVIDIA, of course. We've seen that with TSMC. We've seen that with ASML. So all their shares hit records and they've pulled back. But if we just think about the NASDAQ now, the NASDAQ 100, the biggest 100 tech names in the US, sure, we know that recently hit a record, but now it's down almost in a correction. And of course, a correction is a fall of 10% from its peak, and I've highlighted that here. But guess what? This is not the first time this has occurred. Who can remember back in April? I don't know if you're asking your friends or family, hey, what do I do with NVIDIA? NVIDIA's down 20%. What do I do with tech? Tech stocks are down 5%. So we saw that recently, not long ago, and the history book is repeating itself again. This is a very normal part of markets. I want you to take that away today. But the overall long-term trend is strong. Why? Because not only do we have that future capital spending of 1.3 trillion in the tech and AI semiconductor overall thematic space, such as some of those Mag 7 names, Meta, Microsoft, Google, they've already said they're going to be spending $140 billion just on AI alone. And they pledged that last quarter. So in a couple days, and indeed over the next couple of weeks, we'll probably hear what their expenditure plan looks like again. Has that beefed up? Has that solidified? How's that going to be rolled out? And the third factor that is supporting this overall mega trend over the long term, and why we'll continue to see investors buy the dip, is because we've got government stimulus. So we've got macroeconomic support now. So we've got the US, the EU, and also China pledging 81 and about 48 billion respectively, that's in US dollars, to beef up their chip and AI industries. But bring it all home, what are we saying here? You can't ignore the AI machine learning super cycle. And think about this, it's going to be the fourth industrial revolution, and it will underpin how our lives will change and what our lives will look like in the next 5 and 10 years. I was speaking to a colleague yesterday. When I grew up, we had dial-up internet, and it's hard to believe that tech now is integrating AI and machine learning. When you think about some lofty plans such as Elon Musk and Jensen Huang, the CEO of NVIDIA, think of their plans to build out humanoids and wanting to have a personal assistant in each of our homes in a couple of years. It might not seem that far-stretched. I just want to pause on the pullback, so the tech pullback. This is answering one of your questions about how should I look at tech? How long do I think the tech pullback will go for? Well, we don't know. We don't know. But what I will share is this lesson. We will be seeing investment managers buying the dip. Apologies, there's some formatting issues here. But I just want to share with you that I went to an investment management dinner the other night. This fund manager, an actively managed ETF manager, a Loftus Peak, you can buy that investment on the ASX under the ticker code that's on the screen. They've got $1 billion in funds under management. So I got a little bit intrigued, and I wanted to see what this fund was investing in, because I knew that this ETF was an early adopter, an early buyer of some of those big tech names that we all know, that maybe you discovered and that I started speaking to you about in October last year. So, but indeed, I've been speaking about them for much longer than that. So the Qualcomms, the Taiwan Semiconductors, the NVIDIAs. So Loftus Peak was buying these assets years ago. But guess what? I just spoke about the pullback. We spoke about the pullback back in April. And some of these names were down 20%. And then guess what? As we can see, we've highlighted at the top right, guess what? Investment managers did, including Loftus Peak. Well, they bought the dip. And so we subsequently, after that, we saw their stocks rally and then hit new record all-time highs. And so some investors may have panicked and sold out their stakes, but they were, I guess, losing out, not thinking about the long-term picture. And investment managers take pullbacks and look at them opportunistically because they're buying quality stocks with strong, repeatable cash flows at a cheaper price. So now NVIDIA's shares are down 20%. We've got Qualcomm's down 20%. I just would encourage you to think about maybe either waiting for the dust to settle or potentially maybe getting ready to buy into the dip. Maybe, just maybe. Apologies about the delay. I'm changing my slides, and it's always a delight when technology is a little bit glitchy. NVIDIA is not the only name that I'm quite bullish on, but why is NVIDIA, I guess, you know, the pin-up child? Well, NVIDIA is, we do know that over 50% of their clients are indeed the Mag 7. So Microsoft, Alphabet, Meta, etc. The list goes on and on. Tesla uses NVIDIA's chips, and so too does Apple. But let's take a bigger picture now. I just wanted to break down who some key beneficiaries are of that $1.3 trillion spending in the AI and chip market. Who is going to benefit from that, and what does it look like? So the first thing is to consider cast your minds back to a couple of years ago, 2020. So ask yourselves, your friends who run businesses, how much did they spend on AI? How much did they spend of their company budget, of their IT spending on AI? And I can probably guarantee you that they were spending $0. If they were spending on AI, good on them, but they're an anomaly. But Bloomberg has crunched some numbers, and they've found that overall the spending on AI a few years ago was zero at a company level. Fast forward to this year, we're projected to see IT spending, you know, kind of putting 2% aside to AI and future-proofing their business. So that might be integrating chatbots. That might be scaling up other things and future-proofing the business. That may even also mean buying chips for the business themselves to develop your own hardware and software, if that's what you do as a company. So fast forward 10 years, now that portion of spending on AI is projected to go from 0 to 12% of a company's IT spend. And that kind of, when the dust settles, that'll kind of amalgamate or sit with a total of 1.3 trillion. So the hardware sellers, we all know, think of the Dutch company ASML, NVIDIA, which we've spoken about. So these are key beneficiaries. You actually can't produce much in way of AI without these two companies. And they're leaders in their fields, and they have a lot of quality names on their client book. And so when we're speaking about what names we like, we're thinking about quality, a company that's backed by clients who are going to continue to pay the bills regardless of what's going on in the economy. We're also watching cloud service providers such as Amazon, Meta, and Alphabet. Sure, they're tech stocks, or they're in the tech stock cohort that are part of the pullback at the moment. But we do think that they are going to be leaders in in being key beneficiaries of this AI spending freight train. There's a bit of repetition here. You'll notice that Microsoft we've put down as a software company. They're embedded in most businesses, so too is Salesforce, Palantir, and ServiceNow. So these companies are also integrating AI, and they're rolling out new chatbots. And so how they monetize that is going to drive earnings growth. And for those that know me, I always speak about earnings growth being key to driving share price growth over the longer term. And so that's why we like these companies, because these names that I've mentioned here in the software category, they've got repeatable cash flows. And you probably might also know that I love a company that's embedded also, in the history books. A company will continue to pay the bills regardless of what's happening in the economy. For example, let's say if we were to go into recession, which is there's a very small probability of that. But if we were to go into recession, I doubt that companies would be abandoning their spending in some of these businesses. So that's why we like companies with repeatable cash flows. I'm sure other companies that are integrating AI and are leading the innovation, steam train, if you will, include, of course, Tesla with their full service driving. Of course, got Block with their payment technology. 1 in 3 Americans use Block, either the Square app or their other platform. And for those that don't know, of course, sure, they bought Afterpay, but that is a very minute portion of their balance sheet. They also make 40% of their revenue from Bitcoin transactions. And so this is being also another key beneficiary of the Bitcoin price hitting higher levels. And then, of course, we've got Meta and ASML. They've also got their own front-end integrations of AI. And then last but not least, for those gamers out there, of course, you know Halo, you know Xbox, and you know the companies who run them. So Tencent example, also Microsoft. Again, notice Microsoft is a consistent name. So there's a reason that that they're a $3 trillion company, and across many different sides of the ecosystem in the tech world. Other companies that we think that you should keep your eye on, of course, the cybersecurity company Palo Alto and CrowdStrike, that was hit in the wake of doing an upgrade to their software, and that caused much of the world's internet to come to a standstill. But I just would encourage you to think about, yes, there's going to be a lot of head noise here coming from CrowdStrike, but think about what happened back in 2017 when Amazon's AWS crashed, and it caused a big portion of the internet to crash. And now look at Amazon's shares now. So think long term, look back at history, at prior examples, and think about all the names across the AI market that can benefit. NVIDIA, it's still the one. Rhetorical question. Who watched NVIDIa's CEO speak? He was alongside Zuckerberg as well yesterday. And he spoke about humanoids potentially, or he calls it a virtual assistant, or some type of assistant rather, being in every household in the future. Now, this is really interesting because NVIDIA, sure, their shares are down 20%, but all the companies that are reporting this week, Meta, Microsoft overnight, they're all buying, and they're the biggest buyers of NVIDIA's chips. So if you think NVIDIA's down and out and that it's a bubble, you may be only a few people in the world thinking that. Sure, there are a very small amount of shorters, but for the most part, investment managers are heavy into this. BlackRock and Vanguard are the biggest investment managers in the world, and they hold the majority stake in NVIDIA. And make no mistake, every quarter their shares will be bought by those investment managers with superannuation funds or wherever you are in the world. whether you have a pension or a 701k, some of your hard-earned cash will be put to NVIDIA. But what I'm most excited about NVIDIA is, sure, they've got the H200. We all know the H200 rolled out this quarter. And then, of course, we've got the Blackwell chip. And last but not least, they've released another product called Rubin, and that is coming out in Q1 next year. And the grand finale was, I guess, the humanoid development. The humanoid robot that was we're starting to get more details about that. And we saw that overnight. But the fact of the matter is, they are future-proofing their business. They are also telling their competitors, hey, we're ahead of the curve. We're continuing to innovate. We're continuing to upgrade our chips, and we're continuing to keep our companies in our ecosystem. So their moat is pretty wide. And so, sure, I mean, it would be remiss if you didn't think that AMD couldn't take some market share from NVIDIA in the future. Not right now, but maybe in a couple of years they can. But for now, for the most part, their customers, they're pretty sticky. So, you know, it's not just the Microsoft and the Metas and the Amazons, but it's also the Oracle, the Dell, the Lenovo, the HP, Cisco, HP, Hyundai, and John Deere and IBM. All of these names are pretty sticky clients. And once you're tied and wedded to a name, it's pretty hard to divorce that name. But for the most part, we do see more upside. When I say we, the expectation is that their revenue will continue to grow. Yes, at a slower pace. So for the minute, we're looking at 98% revenue growth, which is extraordinary and one of the best forward growth rates in the industry as we stand today. You can't build a chip, you can't build a data center, and you can't wire together an electric vehicle or a home without copper. The copper price recently hit record all-time highs, and so too did the aluminum or aluminium price. You say tomato, I say tomato. What I want you to consider is, I want you to watch this. I think it's more of a watch and act. So we do know that their prices have fallen away because China, of course, the biggest buyer of these metals, has actually slowed down buying their purchase of these key commodities. And there's a couple of reasons for that. I've highlighted one of them here. So we didn't see stimulus come out from the third plenum like much of the market was expecting, and that caused the copper price to come back. But China is increasingly now, you know that China is very smart. And when they see a commodity like copper or iron ore, the price is getting quite heavy, they'll actually wait off in the sidelines or think about an alternative. In this case, instead of topping up on their copper buying, and buying more copper from Australia, etc. China's now increasingly buying aluminium wire. And this is why I think we should keep an eye on aluminium companies. I've highlighted one of those, that is AWC. Alumina owns 40% of Alcoa. Alcoa is listed in the US, and they're one of the world's biggest producers of alumina and aluminium. Their shares, sure, they've had a phenomenal run. They're up 60% this year. But I think what's most exciting is if you do buy into those pullbacks, you're looking at forward revenue growth of over 400%. So we're not seeing this in any other commodity players. Indeed, in the big tech or big mining space, that is underpinned by tech demand. And of course, you need aluminium for the lightweighting to build a chip, to build a motherboard, and to, of course, to build some AI servers, etc. That we do know TSMC and ASML are constructing. ASML rather. I also think it's worthwhile to keep an eye on BHP. So BHP, for their shares, have been tracking sideways for some time now, but BHP is the world's biggest producer of iron ore and copper. And there was a really good question that came from one of you about dividends. Throughout history, BHP has been one of the biggest dividend payers in the world. They've been paying, on average, a dividend around 10%. So when you think about the cash rate being where it is, and you're thinking about a dividend yield of 10%, you can understand why a lot of investment managers are looking at BHP. Gold. And we're in gold today. I believe gold will hit high highs and will probably hit a new record all-time high. I've been saying this for some time now, and it seems I've become a bit of a history book, but we need to look back at history to look at why gold will probably hit higher highs. And there's a couple of reasons for that. It's not just me saying that. I like to look at facts. So gold buying has actually taken off at an unprecedented level. Why? Central banks are buying gold because the US dollar is expected to fall away if and when the Fed likely cuts interest rates. Remember September. So the US dollar comes down, gold naturally rises. Think about the last time the gold price rallied to a record all-time high. Sure, it was very recent, and that was because central banks were buying. China's buying a record amount of gold, and ETFs are increasingly buying gold as well. But the other reason is that gold has a history of rallying. The last time the Fed cut interest rates back in 2020, gold jumped about 60% to a record all-time high. So if history repeats itself, we're taking the conservative scenario, gold could rally to $4,000. We don't know when. That took a couple of years for gold to hit that higher high, that higher record after the Fed cut interest rates. But it's not just that time. Have a look at the chart. I've highlighted the other last 3 times, including 2020, when the Federal Reserve cut interest rates. Of course, we saw the gold price jump up over 100% on one instance when the Fed cut interest rates. But I'd like to be conservative. If the Fed does start cutting, thinking about more upside for gold. So how do you play gold? Well, we're seeing in investment banks and ETFs, they're buying into the biggest ETF. That's the State Street Gold Shares ETF. That's the biggest physical gold holder in the world. So they hold about $67 billion of physical gold. Deutsche Bank also recently bought about 2 million shares in Barrick Gold. Barrick Gold is the world's second biggest gold producer, but BlackRock holds about 140 million shares in Barrick Gold as well. A company that I'm actually personally invested in is Newmont. And so why am I interested in Newmont? Well, Newmont is the world's biggest producer of gold. And for those that don't know, they took over Australia's biggest gold producer, Newcrest Mining. So they're dual listed. You can buy them on the ASX and the New York Stock Exchange. But why I like gold producer Newmont is because their revenue is expected to grow about 40% this year, 8% next year. And then if I compare that to Barrick, it's got a little bit more hot sauce than Barrick. So Barrick, you're looking about 16% revenue growth. Down under, we know the gold price in Aussie dollars does have a probability of hitting higher levels. And so that's why Evolution Mining, the ASX-listed gold play, is expected to see a potential revenue growth of 49% this year. So that's another stock to keep your eye on. Increasingly, the world we spoke about is, I guess, being tapped and pushed to use uranium as a clean source for energy. Don't just take my word for it. Do a Google search and type in World Economic Forum and NATO, and you'll find that the commonality might also be the Paris Climate Accord. We're seeing about 1 in 3 homes in the US powered by uranium. And if you have a look, what on earth has Jessica put up on the screen? You'll have a look at we call them candlesticks. They're basically a green candlestick is a higher price for the uranium ETF, and a red candlestick is a lower price. But overall, the overall long-term trend for uranium companies, as tracked by the world's biggest uranium ETF, URA, we can see that continues to hit higher highs. So we have to watch uranium. This is a really good way to watch it, and a lot of investment managers and sophisticated investors are using the ETF URA to play uranium. So if we think about where the world is going, we know that there's a lack of supply for uranium because of ESG reasons. There's only so much uranium we can dig out of the ground. And also on the flip side, you think about oil. Also for ESG reasons, we've got restrictions on the amount of oil that we can actually pump out of the ground as well. The funny thing is, you've got the world's biggest producer of oil, China, Sinopec, actually downgrading oil demand. They've consistently said over the last couple of years that they see the oil price heading lower because demand is heading lower. And I think you really need to sit up in your chair and pay attention when you've got one of the world's biggest oil producers, Sinopec, telling you that they see lower oil demand. You really need to think about why that is and think about the alternatives. For those that don't know, 149 gallons of oil is basically equivalent to one small uranium pellet. And one uranium pellet is the size of a finger. And that same uranium pellet is also equivalent to 1 ton of coal. So uranium is increasingly being upgraded as the asset to watch for the future. Why? Well, data centers need to keep the lights on 24 hours a day, 7 days a week. And this means that businesses such as Amazon, such as Meta, such as Microsoft, etc., they're increasingly seeking for cheaper, greener sources of energy. And so this is why we're seeing uranium stocks and uranium ETFs entering an upgrade cycle and hitting higher levels. In fact, I've highlighted, as we can see at the bottom right, we can see that there's a really strong correlation with uranium and tech stocks. So they're both hitting high levels, and you have to ask yourself why. Well, it's because these innovators, these blue sky hyperscale tech companies in the NASDAQ 100, they can't innovate without AI and chips. And to power AI and chips, we need data centers. And we need to be constructing them in manufacturing facilities. Increasingly, what's holding all that together and to keep the lights on is, of course, uranium. So there's a very strong correlation with uranium, and I've highlighted the uranium ETF and the NASDAQ 100 down the bottom right. You just can't ignore uranium any longer. The company that I'm watching is Constellation Energy. I mentioned it at the open. It's one of this year's best performers on the New York Stock Exchange, and so too is NRG and Vistra. But I really like Constellation Energy. Why? Because they've been tapped on the shoulder directly by some of those big tech Mag 7 names who are actually getting uranium clean energy directly from Constellation Energy. And for those that don't know, it's not just big tech companies that are increasingly being powered by uranium. We've got 1 in 3 households, as we're saying, that are keeping their lights on thanks to uranium. The big question is, what does all this mean? What is going to happen to tech? What is going to happen to uranium? What's going to happen if we get a Democratic win with Kamala Harris now the likely candidate if her party wins? What's going to happen if our Republican, the former president of the United States, Trump wins? Well, I have been on media and telling some clients that it's quite dangerous to position your portfolio for a win. In fact, I think investors should be focusing on the fundamentals, where they see the most earnings growth, and really paying attention to what's happening at the economy. Where are the mega trends? But if you want to sit on the fence, I can understand, or keep some cash on the sidelines. I can understand. In fact, this is something that a lot of investment managers tend to do. They don't have 100% of their cash invested in equity markets when we're going through a presidential election. In fact, you see most of the big money, I guess you could call it some smart money, really start to flow into markets in the tail end of October. And I've highlighted that here. We can see on the US market throughout history, this is over the last 30 years, we start to see money start to enter the market in October, and the most part of the market, the most part of investment manager investing in the lead up to an election is capital being deployed in November. In Australia, it's a little bit different. We're entering reporting season, but for the most part, we still are expecting that Santa rally. And of course, that coincides with the US election. Once everyone is happy and they know who's going to be a leader of the US economy for the next 4 years, they know what policies will be front and center, then they're happy to deploy capital in December. But what I would encourage you to think about is this. If you do want to position your portfolio for a potential Republican win, knowing that on the polls as we stand today, in the US polls and on here down under in Australia, we are increasingly seeing the odds favour a potential Trump win. If you do believe that Trump will win, then you might be positioning your portfolio for potential upside in Bitcoin, for example. You could look at some of those names that we've mentioned, such as Square, or you could look at other companies such as Mara, the Bitcoin miner, or you could look at MSTR. But regardless of who wins, I do want you to think about defense always being the key winner. So we do know in December, once we find out who is going to be leading the biggest economy in the world, we do know we're probably going to see more money going into defense. So I want you to think about the ETF ITA, India Tango Alpha. I spoke about that for those that have been following me here on Moomoo, and more broadly the commentary that I put out to the media. We've been speaking about Lockheed Martin. Their shares hit higher levels, and so too did the ETF ITA. We're also seeing higher levels in companies like Raytheon. Now, the commonality of Lockheed Martin and Raytheon is the majority of these two companies, they're the US biggest contractors. So all their contracts, the money that continues to flow into their door year after year is the US government. I just wanted to get to some questions now. So thank you very much to everyone who submitted some questions. I'm just going to try and see if I can whiz through these quickly, but just as a reminder, please submit your questions. If I don't answer them, please submit them to the Moomoo Learn Premium and I'll endeavour to get through those. So question one, how do I analyze a stock? What features do I use? I just want to mention a couple of things here. So on Moomoo, one of our favored tools amongst investment managers that I speak to, amongst sophisticated investors, and something that I like to personally use is the earnings estimates. So we all know in the analyst world, investment management world, we value a stock based on its future revenue and future cash flows. So, sorry, can someone please mute themselves? I can hear myself talking. Thank you. We need to be looking at Moomoo revenue and earnings estimates. I also do recommend that you should act like an investment manager and think about buying on pullbacks. Outlook for equities. My outlook for equities is pretty strong. As I've been saying, all my commentary is available on Moomoo and also on our public-facing website in the media that I've been in. So in the first half of the year, when markets have been positive, indeed they were up over 10% in the US's case. We do know that history has a chance of repeating itself, and there's an 80% chance that equities will be positive in the second half. That's looking at history. Again, spoke about election volatility. Be mindful of election volatility causing hiccups in markets. So keep an eye on the VIX and also be really aware that you'll probably see some investment managers sell into the strength and buy into the weakness. So when you see a big stock pop, just be mindful that you'll probably see some hot sauce or some profits taken out of the top. How do I spot a potential winner on the stock market? How much is business management, number crunching, macroeconomic factors, political outlook, etc.? So when I look at a company, I would not buy into it unless I've looked underneath the hood. I want to be looking at the revenue estimates. I want to be looking at the quality of its clients' book. And where does the company see itself in the next 5-10 years? So in this market, you want to think long term. And I also do like looking at, when we're thinking about the ASX, I like looking at companies that have got a strong history of success or companies that are underpinned by government contracts. Speaking of, we put out an interview with Drone Shield. Drone Shield is one of the best performers on the global share market this year. And it's one of the best performers on the ASX. The best performer, rather. Its shares were up 600% at one point, but they're now off their highs, and they're up about 275%. But why am I speaking about Drone Shield? I encourage you to listen to that interview on Moomoo. Most of their revenue, as you'd see, is from the US government. To answer your question, when picking a stock, when picking a winner, I want to see growing earnings, growing cash flows, quality clients. And that's my metric. Also, lastly, I look to or for weakness to buy into dip. The gold price. This is another question. The gold price is performing well. What do you think? Will they eventually gain value? Yes, I covered that in the presentation today. I'm expecting higher highs for the gold price. I spoke about gold stocks to watch. And just to reiterate, they are Newmont, Barrick, and also Evolution Mining. Macroeconomic factors, what will have the most positive impact on global markets in the next 5 to 10 years? Great question. So without a doubt, the biggest thematics that are driving equity markets and will continue to drive equity market valuations and stock markets and returns for you are AI and chips. We spoke about that $135 billion of stimulus headed for the industry. Plus, the second big thematic that I like is defense. So when you have NATO pushing an economy to spend 2% of the amount of money that they make on defense, you've got to ask yourself, if NATO is pushing a government to spend 2% on defense, you've got to ask yourself, why don't you have some of your money in defense? Because you know that sector will continue to get money year in, year out. Another question I want to get to is Apple. What's my view on Apple and the foldable iPhone? Yeah, great. I actually would love the foldable iPhone if it came out. I would be a buyer. But I would encourage you to think about this. Firstly, yes, Apple is a great company, multi-trillion-dollar valuation, but their earnings estimates are not attractive. Their earnings estimates are only, suggesting 1.2% growth this year and 8% next. It's not really that compelling. I would encourage you to instead look at ASML. ASML is the world's leading company, what the world relies on to make, the machines that print the chips. So they're mass producing those chips. They're a Netherlands company, and think about this: 28% of their revenue is from TSMC. 22% of ASML's revenue is from Samsung Electronics. 10% of ASML's revenue, Intel. And then think about the other chip leaders. SK Hynix, they're the leader in high bandwidth memory, for those that don't know. And you've also got Micron Technology. These companies are also reliant on ASML. All in all, 65% of ASML's revenue is from the world's leading companies. So I really think you should be looking at ASML. Also think about this: 4% of the iShares Semiconductor ETF stocks, we know 4% of that is ASML. Why am I saying that? Because each quarter when investment managers are funneling money into chips, ASML will cop some bids, as we call, or they'll see buying. Here's an interesting point for ASML. I spoke about ASML a couple of months ago when I was on TV, and I said that I'd be waiting for a pullback to buy into ASML. Why? Because they're expected to report about $6 billion in revenue, up from $5.3 billion. And so they reported that, and their shares were up 61% at the time I said that. But their shares, ASML shares, have since fallen back. They've fallen back to a valuation that I think will probably start to get some bites and nibbles. They're still up 21%, but I always say I like to buy in pullbacks. Quality companies, buying them in the pullback is key. So I keep an eye on ASML. Thank you for your question on tech stocks. Do I think they're overestimated? No, pardon me, excuse me. I just want to flick back to a slide, pardon me. So at the beginning, we spoke about the tech pullback. Do I think they're overvalued? I just want to highlight one thing, and that is this. So I spoke about the rotation out of tech and out of big tech into small caps, but I think the market will be really disappointed if we don't see forward revenue growth of 10.4%. So we are expecting that. And once the dust has settled from this reporting season, we'll have a really good indication as to what these companies are expecting for the next 12 months. And that will kind of dictate, the ebbs and flows. But for the most part, as we're saying, we're expecting higher highs over the long term on the back of those structural tailwinds. Sure, there's going to be pullbacks. It's just a matter of how deep will this tech pullback be. Obviously, Microsoft results were disappointing overnight, but you'd expect dip buyers to come in, as we're saying, because the last time we were this oversold was back in April, and then the market springboarded higher. Sorry, I'm just going to skip forward to get to the rest of the questions. BYD versus Tesla, which shares would I buy? Well, I can't say what you should buy, but I can tell you this. I personally own a Tesla. And the reason that I own Tesla is because I'm privileged to say that our company has got a presence in Shenzhen, in China. And of course, we know that BYD is the most used vehicle company in China. And so they've got mass penetration at the moment. And the reason for that is because the Chinese government has a contract with them, and they've approved BYD as their key supplier. But I mentioned, for those who are looking at the commentary that we put out, I mentioned that the game-changing moment for Tesla was when Tesla was approved as a key supplier for the Chinese government. And then, of course, we started to see some Chinese organizations start to buy Teslas, and this is expected to be a tailwind for Tesla for their earnings growth. The other factor that I really find attractive about Tesla is, of course, its shares are undervalued, but their full self-driving FSD, that's got a multi-billion-dollar valuation just in itself. So forward revenue growth is expected to be several $billion for a few years out. And so this is a Bloomberg estimate. And the market is also saying, if Tesla can execute and get FSD right, which it looks great, it feels great from what I've heard and from what I've read. But if they can really start to see more earnings growth manifest because of that FSD, then Tesla will be a huge beneficiary of that. The other hot source for Tesla is, of course, they are developing their own AI, and of course, the other factor is, they're developing some form of humanoid robot. I've yet to see the details on that, but there's with Tesla, there's many ways to, I guess, skin a cat. Two more questions, and then we might have to close off. So the ASX, great question. What makes the ASX such an attractive exchange for other countries compared to other stock exchanges? Is it because of the smaller market? This is a really good question. I just want to flick over to this. So the reason that foreign investors invest in Australia is number one, because of the quality of our businesses. And we spoke about BHP earlier. So BHP is just one of a few mining companies that make up 40% of the Australian share market. There's another, I guess you could call it 40%, that's made up of big banks. And these two sectors of the market have got quite sticky clients. And there's a reason that the Australian share market is kind of, sitting around the vicinity of record all-time high territory. But it's not exactly shooting the lights out either. And that's because the revenue growth is expected to be negative for the ASX 200 this year. So then you're kind of scratching your head, why would someone invest in Australia? Well, it's for the dividends. I spoke about BHP, I spoke about the mining sector, I spoke about banks. So these two sectors combined throughout history have delivered some of the strongest dividend yields across the world. And so foreign investors like our companies for their dividend payout history. And so you might not get the revenue growth and the upside in share price growth, but you're investing in Australia, and foreign investors invest here for the dividends. The other reason is, of course, because of the composition of our economy. We have a AAA rating, and so what's not to love? Another question, is it worth buying cannabis stocks even if Biden is gone? I'd say stick to to your fundamentals. I'd never be buying a stock based on who could potentially win. Sure, some stocks in the cannabis sector have been seeing exceptional gains, but they're quite volatile. But I would also encourage you to look at some ETFs in the cannabis space as well. It'll be really interesting to see if you can see the legalization of cannabis in other states of America. Of course, for those that don't know, cannabis is legal in many states, including New York and Canada. But it's just waiting to see, of course, a great question, if the other states or if the US as a whole will potentially legalize cannabis. The other thing that I wanted to mention, answering someone's question, is should I look at small caps if big tech stocks or big Aussie stocks are underwhelming? It's a great question. So I don't think that we should potentially be looking at the entire small cap Russell 2000. You can look at the Russell 2000 ETF if you wanted to, but there's lots of calls saying that this ETF is a little bit potentially overstretched. But I would instead potentially to invest directly in companies that have got robust balance sheets. They're growing their earnings and their revenue is underpinned by quality clients. So you've noticed quality is really a key when I'm picking a stock. So that's why I've made mention to the fact that DroneShield is the best performer on the ASX. Sure, their shares are up 270% this year, but if you have a longer term view, the market thinks that their shares will probably hit higher highs over the next 12, 18 months, and that's underpinned by their 73% revenue growth. Then have a look at the best performer in the US, in the Russell 2000, and you've got GeneDx. For those that don't know, this is a healthcare company that's integrating and using AI, and their shares have had a phenomenal run. They're up over 1,000%, the best performer in the Russell 2000. But sure, with these companies, they've got lofty valuations. I always like to look at pullbacks or for pullbacks to potentially buy into weakness. Again, taking that long-term investment management approach. It pays to be patient. It pays to be nimble, to buy into weakness and potentially sell out once you've made your profits. Thank you so much to everyone for today. I will also say everything that has been covered today is general information only. And of course, if you are seeking personal advice, you need to consult a stockbroker, but everything covered today is general in nature. For further questions, please reach out to the Learn Premium section on our platform, and I really look forward to communicating with you in due course on Moomoo or on X or on Instagram. Take care. Bye for now.